Open up any brokerage app today, and you are immediately bombarded by an endless wall of tickers, charts, and terminology, and it leaves most people completely paralyzed. Picking the wrong place to park your cash has real consequences. It can silently bleed away thousands of dollars in hidden fees over your lifetime, or lock up your money exactly when you need it most. At their core, all investment funds are just a pooled budget. Imagine throwing a massive birthday party. Instead of one person buying the cake, decorations, and food, everyone chips in. The fund takes that pooled money and buys a wide variety of assets, like stocks, bonds, or real estate, so you get the benefit of the whole portfolio without having to manage every single piece yourself. We are going to strip away the Wall Street jargon and look at the actual mechanics of the four main types of funds. First, index funds, next, mutual funds, then hedge funds, and finally, ETFs. When you dig into how these vehicles actually operate, the entire landscape boils down to one essential trade-off: how much you pay for management versus how much flexibility you have to trade. This diagram shows how we will evaluate each option. On the vertical axis, we have the cost to own the fund, driven mostly by management fees. On the horizontal axis, we have trading flexibility, how much real-time control you have over buying and selling. Pinpointing exactly where a fund sits on this grid is the most reliable way to match your capital to your specific financial goals. Let's start with index funds. These do not try to outsmart the market by handpicking winning stocks. They simply act as a passive scoreboard, perfectly copying a predefined list of companies, like the S&P 500. There is no human manager in a corner office guessing what to buy next. An automated system just buys the list and holds it. Because you aren't paying a team of active analysts, the expense ratios are microscopic. Most index funds charge an annual fee of just 0.02% to 0.20%. That is literal pennies for every $1,000 invested. But that cost savings comes with a strict mechanical trade-off. Index funds are priced using net asset value, or NAV. If you place an order to buy or sell at 11 a.m., the trade does not go through right then. It waits. All orders are lumped together and executed at a single price calculated after the market closes at 4 p.m. You have zero real-time control over the exact price you get. Despite that complete lack of daily agility, some of the wealthiest investors in history consistently recommend this specific automated approach for the average person. Looking back at our chart, index funds sit firmly in the bottom left. You pay almost nothing, but you give up intraday control. For long-term investors, that rigid 4 p.m. execution is actually a built-in defense mechanism. It creates a psychological barrier that physically prevents you from panic selling your retirement savings during a midday market dip. Mutual funds often look identical to index funds on paper. You're still pooling money to buy a basket of assets. But instead of an automated system, a team of professional managers is actively buying and selling, attempting to beat the market averages. This is the traditional Wall Street model. You're paying for human expertise, trusting that seasoned financial professionals can identify trends that passive algorithms miss. This active approach has a clear use case. If you need exposure to highly specific sectors or complex international markets, a passive list might not exist, and a human navigator is required to find the right assets. The catch is the price tag. Paying for those active managers means mutual fund expense ratios typically range from 0.5% to 1.5%, and frequently higher. Look at this chart tracking a 30-year investment. Even if an actively managed fund performs identically to an index fund, that 1.5% fee devours a massive chunk of your final wealth. You lose years of compound interest to cover their overhead, and despite paying that premium rate, you still don't get trading agility. Mutual funds operate on the exact same 4 p.m. end-of-day execution schedule as index funds. This places mutual funds in the top left quadrant of our matrix. You are paying high fees, but you're still locked out of real-time trading. Decades of data show that the vast majority of active managers fail to beat the market over the long run. By choosing a mutual fund, you are very often paying a luxury price for subpar returns. Then there are hedge funds. These take the active management of a mutual fund and dial the aggression to the absolute maximum to chase massive returns. To hit those numbers, hedge funds use complex strategies like short selling and heavy leverage, borrowing huge sums to artificially multiply their market position. That aggression comes with a notoriously steep cost. Hedge funds typically operate on a 2 and 20 model, an automatic 2% management fee on all your assets every year, plus a 20% cut of any profits they generate. Because using leverage can easily result in losing a lot more money than you initially put in, the government strictly regulates who can participate. You generally have to be an accredited high net worth individual or institution to even get a seat at the table. On our chart, hedge funds lock down the top right quadrant. They utilize extreme trading flexibility, but exact the highest possible toll. While they execute elite financial maneuvers, their steep fees, deep volatility, and restricted access completely disqualify them as a sensible wealth-building tool for the everyday person. This brings us to exchange-traded funds, or ETFs. Think of them as a modern hybrid that attempts to merge the automated efficiency of an index fund with the agility of an individual stock. The defining difference is how you trade them. ETFs are not bound by that rigid 4 p.m. NAV claff. They trade continuously on the open exchange throughout the day. If you see a sudden market shift at 10:30 a.m., you can hit sell and lock in your precise price, giving you immediate, real-time control. And because most ETFs simply passively track an index rather than paying a human stock picker, their fees remain incredibly low, usually between 0.03 and 0.75%. This completes our matrix. ETFs sit neatly in the bottom right quadrant, solving the historical trade-off by delivering both low management costs and high trading flexibility. But that access is a double-edged sword. Having a frictionless trading app right in your pocket makes it dangerously easy to react emotionally to daily market news. ETFs give you the perfect mechanical balance of low fees and total control. But if that flexibility tempts you into constantly buying and selling, you will actively sabotage your own long-term strategy. For 95% of everyday investors, paying for active management is a mathematical trap. This narrows your realistic choices down to just two: index funds or ETFs. To find your exact fit, let's map out the decisions. First, are you an accredited individual explicitly seeking high risk and heavy leverage? If yes, you're looking at a hedge fund. Do you need hyper-specific sector exposure and firmly believe a human manager can outperform the baseline even after paying a premium? Then a mutual fund is your vehicle. Do you want to capture broad market returns while keeping fees incredibly low, but absolutely demand the ability to execute trades in real time during the day? Buy an ETF. Or do you want automated, ultra-low fee wealth building that actually physically protects you from your own urge to tinker when the market gets volatile? Stick to an index fund. In personal finance, complexity does not generate higher returns. It usually just generates higher fees. Building serious long-term wealth isn't about finding a secret Wall Street strategy. It is simply about ruthlessly minimizing what you pay in overhead and picking a system that protects you from your own worst financial habits.